Here's my top 20 holdings, and Realty Income is there.
The largest kind of crown jewel of the net lease REIT sector.
That's the only real estate company. The most of these companies are technology companies. That's why I'm dressed like this.
We're in this environment now. We're likely going to see this rate cut.
I never dive headfirst into any of these companies. You notice I started buying Nvidia at $2.76 a share.
Companies that do pay dividends typically outperform. Hello, everyone. It's Brad Thomas, and welcome back to the Wide Moat Show. I'm joined today with our host, Nicholas Ward. Nick, it's great to see you today. And listen, you got some really cool clothes on today.
Yeah, apparently when we're talking technology today, or at least I am. So I guess if I get the host if I dress like Danny Ives, tech analyst at Wedbush, apparently. So maybe I'll do this more often. But anyway, it's a special occasion. I love technology. Last time we talked tech, I dressed like this. We'll do it again. Maybe the guys from Wedbush watch this and get a kick out of it.
Well, we look forward to that. I mean, we need to do this more often. And I don't know if I've got an outfit for tech. I'll have to think about that. But maybe I can borrow your jacket.
Yeah, I'm going to run out of jackets. We'll be going to the local thrift store here if we keep doing this. But it's fun. It's fun.
All right, sounds good. Well, listen, I want to before we get started here. And by the way, we're going to be talking about portfolios today, portfolio allocation, and really Nick's portfolio, which is something our subscribers have requested. So again, this is going to be exciting for all of those watching and listening today. And if you would, please follow us and drop more comments below, because this helps us create more content for future shows like this one. But listen, Nick, I was just finished this book this weekend called The Science of Scaling. And I posted this on X. I only post books I really like on X. And this book is written by Dr. Benjamin Hardy and Blake Erickson. And pretty interesting book. I would recommend it. It really is obviously talking about scaling and how you can scale your business. And there's a lot of things that I learned from this book as it relates to wide moat research and how we are continuing to scale our business. And by the way, we're just very close to 6,000 followers here on YouTube. So in such a
yeah, I was going to say that. I think 2 or 3 videos. We're talking 5,000 or 6. We'll hit 6 by the time this one goes live, I think. So that's the power of compound interest, and I'm sure that was in that book that you're talking about here. So thank you for all the subscribers, and please continue to like and subscribe if you guys enjoy our content.
Great. Well, another book that I want to point out today in reference, a couple years ago. One of my good friends who was a professor at Yale, he recommended another professor of Yale by the name of David Swensen. Many of you, if you're familiar with Yale and their endowment, Dr. Swensen actually oversaw this portfolio starting in 1985 when he took over. He passed away a couple of years ago, but he grew it from $1.3 billion to $31.2 billion. Beating performance at Princeton and University of Texas and Harvard and many, many other schools. So this is a great book. I'm going to put a screenshot up here of the book. You can get this on Amazon. This is one of my favorite books in terms of portfolio allocation. So I'm going to provide you with a few things in the book, just a few takeaways. This is from Dr. Swensen. Careful investors define asset class exposures narrowly enough to ensure that the investment vehicle accomplishes its expected task, but broadly enough to encompass a critical mass of assets. Now, the basic building blocks for investor portfolios come from well-established, enduring marketplaces, not from trendy concoctions promoted by Wall Street financial engineers. This is the key. Personal preferences play a critical subjective role in portfolio decision-making. Unless an investor embraces wholeheartedly a particular portfolio structure, failure awaits. So the key here is for everyone to establish their own portfolio construction. And Nick, I'm thankful for you today to share some of your picks.
Yeah, no, I love those quotes because when we were preparing for this video, it was kind of hard to do, right? People talked about they wanted to know how we would manage a portfolio. What do we think about asset management, how we enter and exit positions, all these questions. But the problem is there's no one size fits all, recipe for success in the stock market. And so much of it comes down to personal risk tolerance, your long-term goals, all that stuff, which the Yale professor here, kind of just chimed in so nicely and was very eloquent in a short amount of time. So good for him. So today I think what we'll do is, I'm obviously a little younger. I love growth stocks. That's kind of where I cut my teeth. So that's where most of my sort of portfolio and net worth lies at the moment. I think Brad's a little different. He's at a different part of his life, has different goals than I do. So that's one thing to really think about when you're listening today. I'm going to show you guys my top 20 holdings. I'll talk about some more, but what's right for me may not be right for anybody else. I always say that anytime I talk about my portfolio, anytime I'm buying or selling something, I don't have a crystal ball. I don't know what's going to happen in the future. I'm just doing what I think is best for me and my family. And that's basically what everybody has to do. So you may not like to hear that. I think that's some people look for just tell me what to do. Tell me how to succeed. But like Brad said, and like that professor said, so much of it comes down to just your individual risk tolerance. And I like how he said, everybody needs to come up with a strategy and stick to it. And I think that's key, no matter what it is. So Brad, before we get into my holdings, did that professor talk about asset allocation? Did he mention sector weightings? Or I guess maybe more pertinently to our viewers, do you have an opinion on that? Do you have kind of, thresholds you're not willing to cross when it comes to individual holdings or just sector allocations?
Well, interesting enough, Dr. Swensen actually loved REITs, and that's one of the reasons that I started covering him and read his book and read it multiple times. He considers asset class exposure to REITs a hybrid or equity-like and bond-like attributes. So he was definitely in favor of REITs. In fact, the Yale fund had a large exposure to real estate investment trust. But there's another academic think tank, and actually I wrote about this today. You can find this article, by the way, and if you go to widemoatdaily.com, that's our free daily newsletter that goes out to many thousands of people every day. And I hope you'll click on that and subscribe to our Wide Moat Daily. So today I'm writing about Craig Israelinson. He's a professor at the Utah Valley University, and he developed what's referred to as the 712 portfolio. So unlike a traditional 60-40 portfolio, the 712 portfolio is a balanced strategy that utilizes multiple asset classes, of which real estate is one of those. So I'm going to put a chart here, and this is actually, you can see, or an illustration rather, of the 712 portfolio. You can see the 7 core asset groups that make up the 712 portfolio. Again, you can read more about it in our daily article, but you can see the main core asset classes are U.S. stocks, non-U.S. stocks, real estate, resources, which consists of natural resources as well as commodities, U.S. bonds, non-U.S. bonds, and of course cash. But interesting enough, of those 7 core asset classes, guess what's there is real estate. So he also believes real estate is a core asset class. Now, you might recall, Nick, and I may think we've talked about this on previous shows, a few years ago, equity REITs were separated from the financial sector in the Global Industry Classification Standard, better known as the GICS. And we have our own category. Real estate has its own category now. Now, what this does or did, it raised the bar for really what was previously a misunderstood, asset class. So before we get into this, Nick, I just want to point out one thing. I know I harp about realty income a lot, but actually I put this example in today's article. Again, you can see it at widemoatdaily.com, in comparing the REIT performance, and I use realty income as an example, in a falling rate environment. So you can see this chart here on the screen. Realty income, again, this is the largest kind of crown jewel of the net lease REIT sector. From 2009 to 2019, realty income stock price rose from $17 to a high of $79. That's 364%, or 16.6% annualized. And guess what? That's without accounting for the monthly dividend. So it's, again, we're in this environment now. We're likely going to see this rate cut. I wrote about this today. You'll see it in our daily with the Fed last week, with Jerome Powell. Very high probability of a rate cut. And this is going to be great news for REITs.
Yeah, well, that's good. Well, that's a good segue here. So I'll throw up my top 20 holdings. This was as of this morning, August 25th. I put together this spreadsheet. I had to kind of changed some things. All the data here is accurate. I don't want people to know how much money I have, basically. So you guys don't get to see how many shares I own, but you do get to see my cost basis. So here's my top 20 holdings, and Realty Income is there. That's my largest REIT position. I've owned this company for years and years and years. It's actually not a great performer for me. As you can see, it's one of the few on this top 20 list that's negative right now. REITs in general have been beaten down in recent years, this company included, but I'm very happy to hold it. And with all the dividends I've received since like 2015, when I first bought this company, I'm still very much in the positive here. But that's the only real estate company. The most of these companies are technology companies. That's why I'm dressed like this. You see Nvidia, Broadcom, Apple, Amazon, Microsoft, Alphabet, Meta, etc. I basically own the entire Mag 7 except for Tesla. I just can't wrap my head around that company, around the valuation. And as Brad and I have kind of talked about on this show before, I don't think either one of us are huge fans of their leadership. I think Elon Musk should focus more on running the company and not everything else that he does. So anyway, I don't own that company, but I've done very well with most of the other Mag 7, just like everybody else who's owned these companies for the last 10 years or so. That's one thing I wanted to talk about here. I think a lot of people think you need to be fancy, you need to find some small cap speculative bet, et cetera, to beat the market, but that's not the case. My portfolio has consistently beaten the market. I think 9 out of the last 12 years, and then cumulatively over that time period as well. And it's mainly driven by these mega cap tech stocks. They've done so well, and all you have to do is just buy them and own them, in my opinion. I've done very well with that, and it's not a fancy formula. I mean, I do pick my spots. I'm not buying Microsoft right now. Many of you guys know I love Microsoft. I think it's the highest quality company in the world. I'll throw up a fast graph here. I think it's pretty overvalued at the moment. However, I'm very happy to continue to own my position. You can see it's one of my largest positions, my 5th largest position at the moment, because of the very steady growth that it has. We see double-digit expected EPS growth, basically every year in the last 20 years, and then looking forward as well. So those are what I look for. I look for companies that compound very consistently. Most of these companies pay dividends too. Obviously, this is why Moat Research, you guys know we love dividends. I love growing dividends. I not only want to receive a paycheck, every quarter from these companies, but I want that to compound over and over, year over year, et cetera, at a high rate, much higher than inflation. So that's my strategy. I pick companies that have that just grow their dividends at a much higher rate than inflation, that in a sustainable way, which means it's supported by EPS growth and fundamental growth. And when you combine those two things, the shareholder returns and the very fast fundamentals, you get some of these pretty big returns here. As you can see, I'm up over 1,000% on my top 2 positions and over 100% on most of these positions. And that's just, it's not because I'm necessarily a great stock picker. I don't think it's because I'm very patient. Here's another chart that I'll throw up. This is I think the top 10 or 12 biggest gainers that I have. And as you guys can see, I have the cost basis here, but I also have when I bought these shares, and most of these shares were purchased 2013, 2014, 2015, 2016, et cetera. Palantir, 2022, that's just been a rocket ship. Everybody knows that. I got lucky with that. When I bought those shares, I told subscribers that it was a lottery ticket. I didn't know if it would work or not. I felt comfortable allocating a little bit of money to that. It's done very well. But if you remember, Palantir is not on my top 20 positions list because it's a relatively small position for me. I'm not going to place a huge bet on a lottery ticket. So Brad, do you have any thoughts on that? I don't want to just talk for the rest of this video. Do you have thoughts on speculative bets versus kind of core investments? I know you've talked about your anchor and your buoy strategy when it comes to income. Do you kind of have a similar view when it comes to, I guess, growth potential and or speculative risk tolerance?
Yeah, and actually, as I pointed out earlier, I mean, I think this whole discussion is really around risk tolerance, and a lot of that has to do with age, Nick. And of course, you're younger than me, and I want to ask you a question. I mean, I know you have predominantly income dividend stocks, not all, but most of those companies that you have invested in pay dividends. Given the age you are, and I know you've got young children, are you reinvesting your dividends, or are you utilizing that dividend income to pay for school supplies, or just curious, what's your strategy?
I reinvested dividends now, most of them. Right now I'm actually building cash. The market's at all-time highs. I'm a little concerned about some of the macro things. I would like to see a rate cut. I'm not sure if it's going to happen, etc. Leo scared me last week talking about the dollar index going down to the mid 70s. So some months I just take the dividends and add them to my cash pile. But if I'm feeling good, I definitely reinvest them. Looking at the list here, I think only one or two of these companies doesn't pay a dividend. Fortinet kind of stands out to me. That's a cybersecurity company that I'm down 21% on, but that wasn't even really a purchase that I made. That was just a poor options trade. I got a little too aggressive, selling some puts, and I got assigned a bunch of shares. So, but I only do that on very high quality companies. So I'm happy to I'm stuck with Fortinet until the stock goes back up to 100. I don't want to take a loss on that, but I'm sure it won't take too long. The company's growing very fast. So I've talked about that last week, my option strategy. And this is an example of when it doesn't work, right? I made a bunch of money. I accepted my premiums on Fortinet, but I did get stuck with some shares at $100 when they tanked like 22% on earnings. But anyway, I'm happy with dividends. I know a lot of people, they see dividend, and this is the argument that I see. They say dividend is just subtracted from the share price. If company's worth $100 and it pays you a $1 dividend, oftentimes you'll see the share price drop to $99 the next day. That's just the market kind of being efficient. But it's not like all those great companies, Microsoft, all these companies that pay these dividends, they're not eroding their NAV every time they pay a dividend. Over the long term, the share prices rise. Nobody would own dividend stocks at all if every time they paid one, it just, dropped the share price lower. So that happens with very high yield stocks that don't grow their fundamentals and don't grow their dividends. But I hate it when people apply that argument to a portfolio like this. They say, why would you own any of these companies? None of them should pay a dividend. Just, invest in pure growth and then sell your shares if you need money. But that's not something I feel comfortable doing. The reason that I own these dividend growth stocks is right now I'm reinvesting those dividends, like you said, but eventually I am going to accept them. I'm going to, right now I'm in the accumulation phase. I'm buying shares of companies every month. Eventually I will enter into the distribution phase of my sort of investing lifespan and just take those money to support my lifestyle. And when that happens, I don't want to have to sell shares. I hate the idea of working for 20, 30, 40 years, et cetera, buying stock all the time and then getting old and just selling it all and dying with zero shares. That's sort of a depressing mindset for me. It is a little morbid, but I would much rather just keep all my shares, live off the dividends, and then have a bunch of shares to just pass them to my kids or charity or whatever it is that I want to do at that time. We talk about income machines that kind of create these infinite streams of income. Obviously, dividend cuts can occur, but I think the average length of the dividend income streak in my portfolio is like 16 years. I mean, some of these companies, I think Parker Hannifin sneaked into the top 20 here down there. I think they're on like a 64-year annual dividend increase streak. So some of these companies have been doing this for much longer than I've been alive, and I have a feeling they'll be doing it for, far past when I'm gone. And I hope that, maybe when I'm on my deathbed, I'll have a little bit of solace knowing that I built this machine and I'll be able to pass it on to my kids or their kids, et cetera, to help their lives in the future.
Yeah, that's a great point. And I think really, Nick, I was just thinking when you were talking. I mean, I think a lot of this really comes down to discipline. And one of the things that I really enjoy about owning and investing in and really researching dividend stocks is you've got this kind of forced component where you have investors being rewarded. And essentially, the game comes down to really two things, and as far as I'm concerned, in terms of like picking stocks. You have to look at the company's cost of capital. I think that's extremely, extremely important. We talk about that a lot. Even in my latest book, REITs for Dummies, I have an appendix on the weighted average cost of capital, or WACC, for explaining exactly what the weighted average cost of capital is. Maybe we can do another show in the future on weighted average cost of capital, because every company has one, and it's important to understand how the company generates profits utilizing their equity and their debt or their preferreds or whatever capital they have to be able to generate profits. And of course, out of those profits come dividends. Now, not all companies pay dividends, but those companies that do pay dividends typically outperform. And we've demonstrated this time and time again here on our YouTube show, how dividend paying stocks over the long will outperform those non-dividend paying stocks. So Nick, congratulations on really your success. One big takeaway in this book that I just mentioned, The Science of Scaling, is it really comes down to the people on your team and the people you partner with. And at Wide Moat Research, Nick, I'm grateful to have you on our team because you're putting your money where your mouth is, and you're investing in this product, which is extremely important to our members, to our customers here at Wide Moat Research. And I think that's extremely important. The last thing I want to mention, there's a quote here, and we'll talk about diversification, Nick, because I'm just curious how many holdings you have.
Yeah, that was what I was going to click on before we end this video. I mentioned these are my top 20 holdings. And as you guys can see, we got the weightings over here. Down at the bottom, Parker Hannafin's only 1.1% of my current portfolio, right? I some of the top ones are 6%. But what I did was I did put my cost basis ranking on the far right corner. I haven't purchased a share of Broadcom, I think, since 2020. It's been a long time, right? They're my 28th largest cost basis, yet they're my second largest position. So how does that work? Well, the company has outperformed the market by a long shot. So you talk about discipline. That's how that works, right? You can stay very diversified. When I purchased, Broadcom, it was like a 1% position for me. It just grew into an 8% position. And I don't sell stocks just because they go higher. I sell stocks when the fundamental thesis breaks, and that's not the case with this company, nor is it the case for any of these companies you see on the screen here. But yeah, I guess overall, yeah, I looked at it. It's 56 positions. Some of them are very small positions. Oftentimes, what happens? People ask me, Nick, why even allocate that money? What's a 0.3% position worth to you? Well, the reason that happens is because I never dive headfirst into any of these companies. You notice I started buying Nvidia at $2.76 a share. My cost basis today is $14. So that means I've averaged in higher over time. And oftentimes I do it lower. So what happens is I'll buy, say a company, I like it at $10. I'll allocate 50% of my desired, money to that company, hoping maybe I'll buy another 20% at $9, another 20% at $8, and then the last 30% at $5. God forbid I'm wrong and the price keeps going down. I love falling share prices so long as the fundamentals hold in there. So what happens is I'll make that first purchase and I'll never get to make another one. Maybe, the stock just rallies. And at that point in time, I don't sell it. I'll just hold it. I got to pay a little bit of attention to it just because that's the responsible thing to do. But yeah, for my smaller positions, yeah, the reason that they're small is one, they'll be bigger eventually. They'll grow. They're high quality companies. But two, yeah, I tried to kind of average into it and just never got the chance. So that happens a lot to me. I think that probably happens to a lot of value investors, but that's okay. Even the small positions, that income trickles in and factors into the overall kind of income snowball. And some people would say 56 is too much, but I do this for a living. I think that's part of it too, right? I follow stocks for my job. I'm reading 10Ks, 8Ks, earnings reports, et cetera, for 50, 60 hours a week. I know most people can't do that. That's why an ETF might work well for a lot of people, but for a full-time investor or for somebody maybe who's retired and just loves this, if you have passion and energy to it, I do think, just the average Joe on Main Street can outperform Wall Street so long as they're patient and disciplined.
So Nick, another question, in terms of your portfolio allocation, I'm just, how much speculative exposure do you have in that portfolio? And if you can define speculative, I guess, are we talking, do you have any positions that yield, say, 10% or double digit?
I have a few BDCs, but I wouldn't call them speculative. I've talked about them. Ares, Blackstone's, their BDC, Main Street Capital. I think they have 7 to 10% yields. I think they're pretty safe. I don't expect those companies to grow very fast. Those are sort of like your anchors, or those are yield enhancers for me. The average yield in my portfolio right now is about 1.8%. So, you will see those yield enhancers. Looking at my top 20 list, most of those are 1% yielders ish because they're growth stocks. But, so I use my enhancers to bolster that yield overall. And the reason I do that is when I think about my portfolio, what I aim to do is generate a dividend yield that is above the S&P 500s which is only like 1.2% right now. Annual dividend growth that is above the S&P 500s, which is usually 8 to 10%. And then I find if you can do those two things, usually the last kind of leg of the stool, total return, just happens on its own, because you get the yield, you get the higher growth that supports, you get the higher fundamental growth that supports that dividend growth. And as we know, over the long term, fundamental growth is what dictates share price performance.
Well, Nick, this is great. I want to conclude with this last quote from Sir John Templeton. Sir John said, "The only investors who shouldn't diversify are those who are right 100% of the time." So, Nick, you clearly don't have all of your eggs in one basket, or even 5 baskets. You have a
no. Yeah, Charlie Munger would disagree with that Templeton quote, and I'm a big Munger fan, but no, I can't do it. I can't. I don't think I could sleep well at night with 5 or 10 holdings. It wouldn't work well for me. So some people love that, a highly concentrated portfolio, but no, not me. I think about it, and as a real estate guy, I think you can relate to this. It's like a multifamily development is what I built here. If one of my tenants moves out, AKA one of my positions cuts their dividend, it's not really going to hurt me that bad. But if you just own a couple single family houses and one tenant moves out, then all of a sudden you're out, 30, 40% of your net operating income. So I do, that's what I've taken from Brad, kind of his real estate mindset. I apply that to my income stream. I'm generating income with equities. I think Brad likes to do it with rents and rental properties, but it's the same principle, in my opinion. I'd much rather diversify those income streams rather than, like you said, put all my eggs in just a couple baskets.
So, Nick, last question. I know you mentioned rate cuts. You don't seem like you're as optimistic as perhaps I am. And Mr. Market is right now after Friday's Jackson Hole conference. So, Nick, do you see yourself increasing your exposure to REITs, given the fact I just showed you the Realty income chart, 16%, just price appreciation, not including dividends, during that falling rate environment period? Do you see yourself increasing exposure to REITs now?
Yeah, I could, because my cash is 8 or 9%. So I'm obviously very bullish. That means looking at, I have, I think 4% bonds. That means about 90% of my net worth is in stocks right now. So I'm obviously very bullish long term. I always stay bullish. I don't try to time the market, but yes, I love cash right now. I can generate 4% yield, 0 risk free. And then I sell options with that cash and really enhance that. But if that yield on cash drops down to 1-2% like it was a few years ago, then I'm going to have to really rethink that strategy. And in that, on the way to that, REITs, utilities, some of these kind of boring income oriented stocks, I may have to sort of go into those instead of holding cash for the time being. I love that. I think the 4.2% yield I can get on cash right now, but if that changes, I'm going to have to go heavy into some of these kind of more boring stock classes.
Great. Well, we like the fact you invest in tech, because Nick, you got the award today for best outfit. I want to give you that official award today.
Well, there we go. I appreciate it. Yeah. Dan Ives, I hope you're watching. This is an homage to you, good sir.
Yeah. Listen, thank you all for watching today, this episode, and hopefully see you back next week. Please drop us any comments below. We look forward to seeing you next week. We'll keep this going. Nick, we should pass 6,000. Hopefully any day, maybe today. And, looking forward to getting to 10,000.
Yeah, 10,000 is the next target. So thank you guys, and we'll see you next Thursday.
Thanks for watching this episode of The Wide Moat Show. Please like and subscribe below. And also, please join us at the Wide Moat Daily for our dose of daily news. You can visit us at widemoatdaily.com. Thanks for watching us. Have a great day.